Continuing on with financial basics, let's talk a little bit more about the prepaids, so just kind of overview again over the prepaids. First of all, you have your insurance, which is typically, again, on an accrual basis. The types of insurances that are commonly on a prepaid are workers' compensation. And the reason why I say workers' compensation is because most policies are covered over, you pay 10 payments, and usually the first payment is 20 to 25% of your total policy, and then you pay the balance over the remaining 9 months, which makes it a prepaid because there's going to be 1 month that's heavy on the payment, and then there's 2 months that don't have any payment. So consider that if you're on an accrual basis, consider capturing that. You also have prepaid health insurance. Most health insurances, when we're talking about medical insurance, is prepaid a month in advance. And then you either get that money back from your employee, or you pay, of course, partial of what your company is paying. You then also have general liability insurance. And we'll talk a little bit more about the workers' comp insurance and general liability insurance in a later slide. Next, we have deposits, and these, again, are typically both cash and an accrual basis. We have utility, which again is your electric, power, water. Sometimes, most cases, they require a deposit to turn it on. You also have rent, and again, your rent can be a prepaid month. Maybe you had to pay the last month's rent in advance, as well as a deposit. Both of those are considered an asset until you use them or get them back. Next, let's talk about building a balance sheet. Again, the balance sheet runs from year after year, and they're considered permanent accounts because they just continue on year after year. Now let's take a look at the balance sheet a little bit closer. All right, so what I did is I took this balance sheet from an accounting system, and I use QuickBooks as the one that we support. And I just want to give you an overall view of the balance sheet. I'm going to make this a tad bit smaller so that you can, oops, not that small, so that you can see it a little bit less. There we go. So you can kind of see it. Let's start at the very top. First of all, we have our main section of assets, our main section of liabilities and equity. And you'll see that under the assets, these are the total assets for the sample file, and they match the total liabilities. That you always have to have a balanced balance sheet, and this goes back to the fundamentals of your debits always equal your credits. Your journal entries will always equal each other. So you can see that of course, I said there should never be any zero or negatives. In this case, there's just a cash and drawer. It's not really a petty cash, but this would be more of a point of sale type situation where there's actually a cash drawer. It's a separate system. It looks like they overdrew that account, but let's ignore that for the moment, and let's just look at these other accounts. So you have your total cash, your checking and savings, which gives you your total cash on hand. Since this is on an accrual basis, you can see that this is an accrual basis. There's an accounts receivable. If you had a cash basis company, you would not have an accounts receivable account, nor would you have an accounts payable account. You have an inventory asset account, which can be both. You have a prepaid insurance, so we have prepaid taxes and prepaid insurance. You have a security deposit. Going down, you have your fixed assets. You have automobiles and trucks. You have your computer and office equipment, machinery, and then you have an accumulated depreciation. It looks like this accumulated depreciation, because it was so small, either it was the first year of depreciating and they've bought most of these assets in the current year, or there wasn't a proper entry booked from their CPA firm. So this would be an example where you should review your tax returns, make sure your CPA either does proper journal entries in your accounting system from year to year, or they give them to you for you to do those journal entries. Usually they're fairly simple journal entries to enter in. So here you have your total fixed assets, and then of course it sums up all of your fixed assets, and your other assets to come up with your total assets. You have your liabilities and equity. You have your accounts payable account, and then you have a credit card account. And again, like I mentioned, you do want to make sure that if you carry balances month to month, that you do keep the balances in QuickBooks, or excuse me, in your accounting system going forward. We have a sales tax payable. Now we have a customer deposit, which is interesting because it's a negative. Again, you shouldn't have a negative. So what this really is an asset, because if you remember back to early math, you have two negatives equal a positive. So in this case, if I were seeing this under a client's file, I would first of all question why it would be set up as a liability. And if it was incorrectly set up as a liability, I would reset that account up as an asset account. You have payroll taxes. So your payroll liabilities, these are payroll taxes or other payables. Maybe you have child support payable. There's several different types of payables. It's not just payroll taxes that you pull from your employee's payroll. It could be 401 contributions, IRA contributions. Those all appear as a liability on your balance sheet. Going down to our equity. This is going to be the draws that an owner takes out. If this was a corporation, then this would, instead of it saying Deborah equity, it would say shareholder distribution is usually what you would see on an S corporation. We have the retained earnings. Again, the retained earnings are all of your net incomes, the prior year net incomes, whether it's an income or a loss, would accumulate to net out year after year on your retained earnings. And then we have the net income. And net income, I'm just going to highlight this red, even though it's not in the red. I just want to highlight this. This net income is the only number that appears from your from your profit and loss. And what we try and stress to the owners of companies is that your balance sheet is really what makes sure that your profit and loss is reporting the correct bottom number. If your balance sheet is not correct, then your income statement is not going to be correct. So what I encourage owners to do is to not necessarily live on your profit and loss. Of course, you want to make sure that you're earning revenue, but if items are not recorded correctly in your balance sheet, it doesn't matter what your profit and loss says because it's going to be wrong. So you always want to make sure that you can own, or that your bookkeeper can tell you what every account is, and make sure that every account is balanced and reviewed every single month before you close it on a monthly basis. So this is so critical, is the balance sheet. And again, that's the one that rolls over year after year, so it sticks with you. Next, let's look at the profit and loss. I'm going to open up the, oops, let me go back to this. There we go. All right, so let's build the profit and loss statement. First of all, before we go into it, let's describe that it runs only on a fiscal or calendar year. Most companies are based on a calendar year, which is January through December. However, there are some, and they're usually C corporations that I see, or nonprofits, or government contracting type companies, where they'll go either on a July through June, or they'll do like October starting of a fiscal year. And those are determined when you're actually filing for your corporation. That's when you're saying what your fiscal year is, if it's not going to be a calendar year. Now let's take a look at, they're considered temporary accounts, and all the income and expense transactions result in the net income that are then transferred again to your balance sheet as an equity number. So let's take a look at that profit and loss. Let me find it here. There we go. All right. So if I scroll down to the bottom, I just wanted to show you that this number was the same number that was representing on the balance sheet. So let's now go to the top, starting with the income. Now, I don't have account numbers turned on in this particular sample file, but had I turned on the account numbers, you would see that they would start with a 4. So maybe the income would just be a general 4,000 or 400, and then you would count up, maybe revenue would be 4001 or 4010, whatever naming convention or numbering convention you wanted to call it. But our top line income is going to be our $411,000. And then, as I mentioned when I talked about the accounts, you have your cost of goods sold. So this is a wholesale and distributor file. So they have costs associated to producing their revenue. Those costs are wages, you have freight costs, you have materials, you have other cost of goods sold purchased probably that are using in for your raw goods. And then you have commissions. These are all examples of cost of goods sold. It leaves you with a gross profit. So in essence, this is saying that really you only, your revenue, after you had to pay for that revenue, really only netted you $202,000. From there, you take out your overall expenses. So you have a mixture. You have your advertising, you have your businesses and licenses, you have your cars and truck expenses. Here's your depreciation, the one that showed up on your balance sheet. So this was taken in this particular year. You have your dues and subscriptions, and so on and so forth. You also have your insurances broken down. It's good to break down different insurances in this case, just so you can see your overall expenses from year to year. Same with like your professional fees. If you have, especially in the first few years of business, you might have more of your legal and accounting fees. You do want to break that down so you can see year over year what you're spending and do an analysis of are they increasing or decreasing. It'll also help you with budgeting. You have different repairs, etc. So it comes down to the bottom line of your net income. And again, your net income gets recorded over to your balance sheet, and that is what makes your balance sheet so important, is because it's just that one number. Where if you have maybe duplicate charges in your checking account, you're going to over expense on your income, and that would make your expenses incorrect in your income statement. So that's why balancing your checking account, reconciling your checking account and credit card accounts, and really most of these accounts on here should be reconciled each month. That's what will make sure that your profit and loss is actually reporting true revenue, which of course as a business owner, that's what's really, really important, is that everything is correct and reporting correctly. Next, let's look at the statement of cash flows. Statement of cash flows is important for businesses, especially once you get going, to understand that not everything that you spend cash on is recorded as an expense on your income statement. So that's really important that you first understand that. You have your cash in, which is your loans. Maybe you have loaned the company money, or you have a line of credit. You have investments, revenue, and then you have cash out. Your cash out can be notes payable if you maybe had a loan to yourself that you're paying back, or it can be a loan that you've asked from your bank. You can have expenses. So expenses would show up in your income statement. And then you have distribution. Again, talking about the equity account, if you distribute money to yourself or to your business partners, that's cash going out of your company that's not accounted for in your income statement. So this is where businesses can run into problems. They can look at their income statement and say, well, I made $100,000, so why don't I have $100,000 in the bank account? So let's take a look at the statement of cash flows. In the statement of cash flows, you have your net income, which takes the consideration of your, let me go back up here, which takes in consideration of your profit and loss. And remember, that number matched our income statement. So we have that number. We know that that balances. We have the difference in all of these different accounts that's saying, well, after you've taken your net income, where did that money go? So if it's increasing or decreasing, so we've had a decrease in accounts receivable. And I'm not going to go through each one of these, but overall, you can see where the cash is going in and out of your company through that particular period. In this case, it's January 1st through December 15th. Investing activities. So you had a change. You spent $2,500 in office equipment. You got credit for your accumulated depreciation. You also have money that the owner took out. You have that $123,000 that the owner took out in that period. And then you also have something that shouldn't be in here, which is open balance equity account. Typically, you wouldn't see that. Under this financing activities, you probably just see more of the distribution. That's just something that happened in the QuickBooks file that I pulled this from. But you can see the cash at the beginning of period, and you can see the cash at the end of the period. So this all tells you your change of where that money came and went within that particular reporting period. Again, in this case, it was one whole year. Next is looking at the GAAP, and that's the generally accepted accounting principles. You have accounting rules that are used to prepare, present, and report financial statements for a wide variety of entities. The rules are created by the Financial Accounting Standards Board, which is also acronym of FASB. You might hear that when you're talking to accounting people. Also, companies need to follow the rules so that they can show what they're doing shouldn't produce anything misleading. It also makes taxation fair across all business owners. Next, I want to share just a little bit of record retention. Record retentions for the first 3 years. You should have monthly financial statements that you prepare, especially if you don't have accounting software that's keeping track of this and making sure you have backups. You should have credit card statements, and utility records. And then over a 7-year, you want to make sure you keep your bank records, personnel and payroll records, purchase and sale records, general business receipts, vendor and customer invoices, and mortgage loans and lease agreements. Now, some of these, for example, the business receipts and customer and vendor invoices, some people say that maybe 4 years is good, but just remember that the IRS can go back up to the 7 years. So if you have it, it's going to be more information that you can provide them to state your case should you go through an audit. So it's important to keep these either in a paperless environment or in a paper environment. And that concludes financial basics.